In this presentation, we will discuss business forms and business structures. At the end of this, we will be able to list types of business forms and business formations, describe pros and cons of being a sole proprietor type of business form, explain the meaning of a partnership, describe a partnership agreement. When considering going into business or just thinking about business in general, it can be a bit overwhelming when we think about all the different types of formations that can be used in order to create a business and run the business formation. We're going to go through a list of few of these formations, and then we'll discuss some of the pros and cons. Before we do, however, it's important to note that there's a lot of similarities between the different types of business formations, the major goal being principally the same, that we want to separate the business from the personal. And from a bookkeeping side, we do that no matter what type of formation we have. The business has different objectives than the personal. We're going to separate out the business objectives and at least track them in a separate formation so that we can see what the performance is of the business. The business objective is typically revenue generation, or at least to track the revenue in order to have one indication of how well we are doing at our business goal, the business objective, whatever we do for the business. In order to do that, we need to have a separate record of the business versus the personal. No matter what type of formation we have, we are generally going to do that. We're going to separate everything out. On the business side, we're going to try to track it, business separate from personal, and achieve business objectives, one of those being revenue generation. Where some of the differences come into play are when we talk about the different people involved in owning a business, whether that be one individual or multiple individuals. When we have multiple individuals, then the complexity becomes more complex, of course, in terms of how we deal with those multiple individuals. How do we allocate, for one thing, the revenue between those multiple individuals? The other thing that's different, and one of the innovations that happened within business that really kind of helped business to grow in many ways, is the concept of a corporation. And the concept of a corporation means that we have a separate legal entity. We actually give this corporation, this piece of paper, this non-human thing, human characteristics, such as the ability to own property. And what that really does, one of the main things it does, is it removes some of the personal liability that would be involved for people that are involved in a corporation and invest in corporations, really allowing people to invest in corporations without having their personal liability or their personal assets at risk. And that's going to be a huge innovation in order for people to use capital and for new ideas to be put in place and be able to construct businesses and actually get capital from people that have the funds to invest in something but don't want to take on that added liability risk that would go beyond their initial investment to their personal resources in the case of problems. Now, that separate legal type of entity then is great. However, it does come at some rigidity in terms of how the corporation is run and the structure of the corporation, the typical type of C corporation. Many of the other type of entities try to blend some of these things between one, the partnership, which is very flexible, but a general partnership not having some of the liability protection that a corporation has. So some of these other types of entities, we have a limited liability company, we have a limited liability partnership, we have an S corporation. Many of these entities are just variations on the concepts. They're mixes in some way between a general partnership, very flexible type of partnership. There's a lot of different things we can do with a partnership agreement. And the C corporation, which has the benefit of being a separate legal entity and therefore providing liability protection, however, it not being as flexible as a partnership, it being a bit more rigid. So these other types of entities we look into are really kind of variations trying to get some benefit on both sides, the flexibility of a partnership and the liability protection of a corporation being the principal thing of a corporation. So when we think about the three main types of entities, you can think of it kind of like a color wheel that has the main three components, and then a blending of those really is going on for these other types of entities. We think of a sole proprietorship, which is a one individual. We think of a general partnership, which is multiple individuals, but has really a lot of flexibility in terms of how they maneuver. And then in terms of how they make their articles and do profit sharing and those types of things. And then we have the corporation, which is going to be a separate legal entity, but a bit more rigid. And then if we blend and mix a bit in between, especially the partnership and the corporation, we end up with things like limited liability companies, S corporations. We could have limited liability partnerships and so on and so forth. First, we're going to start off with the sole proprietorship because it's going to be the most common type of business formation in the United States by far. By far, most businesses are sole proprietors. Now, if we think about the amount of revenue generated, then the amount of revenue would be highest typically by corporations. However, if we're thinking about just the number of business entity forms, the sole proprietor has the greatest number by far. Why? Because it's the easiest to form. That's going to be one of the major benefits of the sole proprietorship. All we really have to do to start a sole proprietorship is start acting like a business. If we start generating revenue, if we start acting in a way that we are doing businesses and generating revenue and acting for that revenue, not in essence a hobby, but trying to actually generate revenue from it, then we're really acting as a sole proprietorship, and as a consequence, the government sees us as a sole proprietorship, and we have to do things such as report our business earnings on our taxes. Not in a separate tax return, however. It's not like we have to file a return for a separate entity. We generally have to file a Schedule C, which we would then attach to the Form 1040. The fact that we don't file a separate entity return is an indication of one of the benefits and one of the weaknesses of a sole proprietor, and that is that from a legal standpoint, the business isn't a separate legal entity, and therefore we report it basically on our 1040 with just another schedule to it. The problem with that is that if we were to get sued or something as a sole proprietor, then it may be more likely that they could go after not just the revenue that we generated from the business or the business assets, but possibly after the personal assets. We don't have as much of a shield or a differentiation from a legal standpoint in terms of what is it that is our business entity lives and our personal entity. And therefore, from a liability perspective, someone is more likely to be able to go after personal liability, personal resources, rather than just the business resources. So when considering the sole proprietorship, we got to weigh the pros and cons of that and be more careful when we're doing business as a sole proprietorship and possibly try to cover ourselves with things like liability insurance. Clearly, one of the benefits of a sole proprietorship is that the owner of the business has complete control over that business and can make decisions quickly as they see fit going forward. And that can be really beneficial when we're talking about a small business that wants to move quickly. When we get to something like a partnership, then of course we have to negotiate within the partnership, which could be a good thing. We have more people to discuss and get good ideas with. But it's also could be more difficult to move forward in that we have to have some type of agreement, of course, between the individuals involved to move forward on any particular decisions, whereas a sole proprietor, the individual can move forward with whatever they think is the best move for the business. When we go to a corporation, of course, then we're going to have more of a hierarchical structure, which could make it a little bit more difficult at times to move forward and move quickly. So when we're talking about a small business, oftentimes they're weighing the pros and cons of being a sole proprietor, limited liability protection of some other types of business entities, and the benefits and cons of being something like a partnership and having more people involved in the decision-making process. So in terms of a partnership versus a sole proprietor, the question is oftentimes, should a small business take on a partner, or should possibly a small business take on employees to help, or contractors to help out the business? If they take on contractors, then they still remain in control of the business and ultimately making business decisions and then pay for work to be help them. If they take on a partnership, then of course now you have decision-making power within the business, and you need to be able to work through how are you going to move forward with the business and be able to negotiate that process going forward. However, If you have a partnership, it's often easier for people to contribute capital. If someone's going to contribute money into the business, then they're probably going to want some type of ownership percentage. And that's going to be one of the benefits of a corporation versus a sole proprietor as well. A corporation, to buy stocks in a company, is going to have some more type of power in order to have decision making. So that's going to be some of the pros and cons of a sole proprietor. You got complete control. However, you have some liability issues that are less secure in terms of the line between your personal resources and the business resources, which could lead to liability issues, and it's a little bit more difficult to raise capital. If we want to move forward with something that's going to be needing more money in order to expand, it's going to be more difficult to generate that money without just revenue, but by having more capital from other individuals. It might be a little bit more difficult to get a loan as a sole proprietor with one individual involved rather than having multiple individuals that may be able to help with that process. The next type of business entity we will discuss is a partnership. A partnership will be very similar to a sole proprietor in that we have that revenue generation goal and objective of a business. However, here we're going to have two or more individuals involved in the carrying out of the business and some form of profit sharing between those two individuals. It's important to note that we call these two individuals, of course, partners within the partnership. It's important to note that the partner could be someone other than an individual. In other words, we could have a business entity, such as a corporation or some other business entity, included in a partnership as one of the two or more individuals involved in the partnership. Another example of where we really have implemented some human characteristics to non-human things, like corporations being able to be a partner within a partnership agreement. A partnership is going to be easy to form typically as well. If two individuals are getting together and earning revenue, generating revenue, then in essence, like a sole proprietor, they are now a partnership, basically because they have that business objective of generating revenue, and now they have that profit sharing perspective in that they're divvying up the profits in some way. Partnerships are going to have a similar problem in that we don't have the same type of level of a separate legal entity from the partners. So the partners still have some of the liability problems in terms of not being a separate legal entity as the sole proprietor, and therefore are more vulnerable to things like a lawsuit, not only being able to go over after the business assets, but possibly the partner assets as well. Although the partnership is not a separate legal entity and we still have that liability issue between the individual partners and the partnership itself, we do think about the decision making from the partnerships for the most part to be from a entity rather than individual partners. In other words, the owners of the partnership can make agreements, binding agreements, that would bind not only them, but their other partners that are involved within the partnership. Therefore, we have this type of agency problem, or this type of agency representation, in that either of the partners can make decisions that will be binding in terms of the joint assets of the business, as well as create liabilities for the business. And that's where the partners need to be careful and be able to understand that the individuals involved, both partners, can make decisions, and those decisions may be binding not only to the individual that made them, but of course to the partnership as an entity. The most common way to set up a partnership is to have a partnership agreement, to have the partners meet and set up some type of agreement between the parties. If a partnership does not do this and they basically act as a partnership and have profit sharing, we could still say, well, they're basically a partnership from a legal perspective. However, meeting, have an agreement on the partnership is best way to set up a partnership. Now, it's possible to do that with an oral agreement. However, it's best typically to put things in writing. The more defined the partnership agreement is, the better it is typically for the individuals, the partners involved, because then they have a better idea of what is expected. At the minimum, we would want to say what the profit sharing will be for the partnership agreement. It does not necessarily need to be a 50-50 split. It could differ substantially, and that's one of the huge benefits of a partnership agreement. We are able to say, hey, if one individual is working a lot more than the other individual, then we may want the profit sharing to be split in such a way that it would favor that individual. If one individual puts a lot more capital into the business in order to start the business, then it would make sense for the profit sharing possibly to go to that individual at least for a time. There's also a lot of different types of variations that we can put into the profit sharing agreement for a partnership, such as some type of guaranteed return on the capital in order to compensate the individual who put in a capital investment, a lot of money to start, or some other type of assets in order to start up the business. And we could include something like having a distribution for the work done, a type of salary allowance, or a type of compensation that would be guaranteed as part of the revenue distribution when we divide up the revenue for someone who is putting in more service, more work towards the business. A lot of flexibility with a partnership in terms of how that partnership agreement can work and how the profit sharing within it can be set up. When considering capital contribution or the generation of capital from a partnership, the partners themselves often will put in an initial investment or possibly investments in the future within the partnership, which we would call capital contributions, so that the partnership can then use those capital contributions in order to achieve the goal of revenue generation. As a partner puts the capital contribution money or other resources, other assets into the business, the expectation is to generate revenue, and then the partnership has some claim to that. The assets that they put into the business will have to divvy up, the business in essence owing those resources back to the business in some way, shape, or form, hopefully through the generation of revenue and the dividing of the profit sharing. But we need to track the amount that is owed to the partners as we move through the partnership agreement in terms of both capital contributions and the revenue generation that could either be distributed to the partners when we generate revenue, or it can be put back into the business and used in order to help facilitate the growth of the business for the objective, the goal of future revenue generation. When considering a variation of a partnership where we have a limit, we're going to have one or more individuals that are partners but have limited liability in that they're not making the decisions typically of the day-to-day negotiations of the partner, and therefore we can think of them more as a type of partner that is contributing capital oftentimes in order to generate revenue, but not being involved in the day-to-day management of the partnership, and therefore there's granted a more of a liability protection for those partners. And you can see the concept of why we would want this type of concept involved in a partnership agreement. If a partnership, for example, is looking to generate revenue, they have a good idea, but they don't have the capital, they don't have the money, they may want to take on a limited liability partner who does have some money and have some faith in the individuals to generate revenue and are willing to give that money to the partnership for revenue generation. However, they would be more risky to do so if they were subject to liability beyond that initial investment. And that's going to be one of the benefits of a limited liability partner who could then put in money but not be involved in the day-to-day transactions and therefore not be as liable as general partners in terms of their personal resources, their personal assets in the case of some kind of problem like towards wrongful acts, negligence, or misconduct committed by another partner within the partnership. Next type of entity we will discuss is a corporation, a standard C corporation. And the C corporation, the big innovation here is that the C corporation will be considered a separate legal entity and therefore be able to take on some human characteristics such as being able to enter into agreements and own assets and take on liabilities. These being things, of course, that typically we would think about in terms of individuals having those types of rights. If we attribute those to a business, we have similar types of advantages we saw with something like a limited partner, in that a business can then get resources, generate capital from more people who would like to invest in the business and help the business to grow, but who would be skeptical to do so if the business was going to generate personal liability for them beyond that initial investment. And we can all see this when we think about our 401k plans and the money that we invest. We would be much more skeptical to take money out of our checking account and put it into a fund that would be tracking stocks and be corporate stock owners to own stock, if having doing so would expose us not only to the loss of that initial investment, but to loss to our personal resources, such as our house or something like that. That would be a very limiting concept. The ability for a corporation to generate capital through issuing stock and then having some kind of authority or power ownership of the business without exposing the personal resources is going to be a huge benefit to the business. And we saw it a bit in terms of a limited liability partner. If we have a limited partner, we can see this concept in place where the partner is able to invest but not be in the day-to-day type of transactions. A corporation will be much the same in that the owners themselves, all of them, will be in the form of stockholders. So the idea of a corporation to have this separate legal entity would be that there's going to be some layers in terms of how the corporate structure will be set up. The major benefit of the corporation being a separate legal entity and providing that liability protection also comes at some costs as well, and the costs include the fact that a corporation is typically a bit more expensive to form, and a corporation is typically going to have some more rigidity in terms of how to have the profit sharing agreement and how to set things up. For example, the partnership, we have a partnership agreement that has a lot of flexibility in terms of profit sharing in particular. Whereas a corporation, we have corporate stock in the corporation, and the stock has to be, in essence, all the same for the most part. When we talk about common stock, the common stock needs to be the same. That's the point of it. We can have separate individuals that own more or less common stock, but we can't have the common stock, the normal stock, the common stock have different characteristics from one to the other. They all need to be the same form of common stock. Whereas in a partnership agreement, we can assign different types of profit sharing agreements to the different partners. So that flexibility is something that is lost a bit in terms of the profit sharing in a corporation. It can also be more expensive to form in many cases, and it can also lead to, because it's a separate legal entity and the fact that the business has some rights given to it, including the ability to generate revenue, that's one of the consequences of being able to own assets and take on liabilities. It could lead to a case of double taxation as well, meaning tax often happens on the corporate level when earnings are made. And then when the earnings go from the corporation to the individuals, the stockholders, we call that a dividend. And rather than being just a distribution, as it would if we're talking about a sole proprietor, which would not be taxable, we would tax it at the point in time it was earned out on a sole proprietor. When we give it from the corporation to an individual because they're separate legal entities, or in part because they're separate legal entities, the dividend is often taxed as well, meaning that revenue that we had is taxed 2 times. So that, of course, is going to be a huge downfall of the corporation, a huge problem. You have this great benefit of being able to generate revenue, generate capital, and you have this problem of possibly having a double taxation because or a cause of a relation to that benefit that was generated from having a separate legal entity. Other types of entities, the concept of a limited liability company, the concept of an S corporation, are types of entities that try to have the best of both worlds, to try to be a separate legal entity in terms of being able to more easily generate capital and to be able to have liability protection. However, also having more flexibility in terms of how they're going to have their profit sharing, and of course, try to remove the idea of the double taxation. And the way that would happen is to have a flow-through type of entity where, although we report it as a separate legal entity, we in essence have it flow through to the individual tax returns and basically be taxed on the individual level rather than it being taxed first at the corporate level and then again on the individual level in the form of distribution. rather than having that double form of taxation, we would have the original income generated from something like an S corporation that would flow through at the point of generation, not the point at which it's distributed in the form of a dividend, at the point of generation to the individual returns, and the individuals then would be reporting the income at the point in time it was earned by the entity. So recapping this, we can see that there's those three form structures basically. We have the sole proprietor, one individual, not a separate entity, has complete control. We have the partnership, which a general partnership where we have a lot of flexibility between the partners acting as agents, the partnership in general making decisions about their resources and how to apply them and what type of debt to take on, and then but also not being a separate legal entity for the general partners. And then the corporation, which is not only separate in terms of form, how we keep the books, but separate as a separate legal entity, giving the corporation rights in order to own property, but also problems, which one being double taxation, and then of course variations to try to mix this up between mainly the partnership characteristics and the corporation. How do we avoid double taxation by having a flow through rather than a two-step process? How do we, and that could be formed by a S corporation or a limited liability company. How can we get more flexibility in terms of the partnership agreement so that we can have different types of profit sharing than the more rigid structure of possibly a corporation? They can have different mixtures in order to try to pull both those characteristics. How do we keep the liability protection of having a separate legal entity without having the risk or the problems involved of the more expensive cost of formation and the double taxation that would be involved in that process? For more accounting information and accounting courses, visit our website at accountinginstruction.info.